Money. Money.
Federal funds rate for mortgage interest rates. Thought that I'd bring that into studio today. Federal funds rate right now is currently at 0.5%. Every month, all eyes turn to the Fed to search for clues in the languages used to try to determine when the rate is going to increase, what's going to happen, which we know recently that it did. Now, with an increase, what does that affect? Your credit card bills could be more expensive. The vast majority of credit cards in the United States have been on variable interest rates. Generally, your interest rate is determined by the set rate that comes from your particular cardholder agreement. You may not notice too much of an impact, especially if you carry relatively low credit card balances. However, if you have high credit card debt, say $10,000, a small rate can be pretty noticeable in the payment. In this case, an extra 1% interest rate, an extra $100 per month. Now, this would mean that out of your monthly payment, about $8,008 more will go towards interest, not paying down your balance. Now, in the short term, a rate increase means it will either take you longer to pay off your credit card debt by simply making the minimum payment, or the minimum payment amount may increase. Now, some of your investments can be affected as well. Interest rate changes can affect your investment in a variety of ways. For instance, banks will largely lend portfolios can see profit rise with interest rates because the spread between the interest banks paid and the interest that they charge tend to widen as interest rates rise. However, some investments can negatively be affected by rising interest rates. This is especially true for fixed income investments like bonds. Bond price fluctuates based on the market interest rate and the coupon rate and on the bond. For an example, let's consider that you buy a 30-year Treasury bond today at $1,000, and on your bond has a coupon rate of 2.6%. The bond will pay out $26 per year for the next 30 years. However, let's say that the rates jump up 0.5% and the standard coupon rate for the 30-year Treasury rises to 3.1. Because that's the yield new investors expect, you would have to sell your bonds at a discount in order to make them competitive with the market. In order for your bond, which pays $26 per year, to yield at 3.1%, its value would drop by about $840. Now, this is a simplified example, and there's a lot of other factors that contribute towards the bond prices. Plus, bonds with shorter maturities will be affected less than longer ones. Just be aware of how rising interest rates can affect your fixed income investments. Now, last, mortgage rates. Mortgage rates are moved mostly by the market, but the Fed can have a huge influence on rates. So they're not directly tied to what the Fed's doing with the funds Fed rate. Even though the federal fund rate is not tied to mortgage rates, it affects them indirectly because of the impact of the lenders when they're the borrowing costs. So if it's more expensive for banks to borrow, they will pass the expense on to the consumer. That makes sense. In the correct environment, any change will have a direct instant or negative impact on mortgage rates. Now, the Fed also uses monetary stimulus programs such as bond purchases to help keep mortgage rates where they want them. When the Fed buys mortgage bonds in the U.S. Treasuries, it increases demand for these investments. Such purchases tend to keep mortgage rates down in the other direction. So the Fed can decrease demand by selling bonds, which could send mortgage rates up. Now, the Fed economic projections also influence mortgage rates as they affect investors' sentiments. So global economy outlook usually means lower mortgage rates. Signs of a stronger economy, often higher mortgage rates. So here's some things that you can hear on interest rates as far as how they're affected. And I want to mention this because it's really common that you hear mortgage rates that they're tied to the 10-year Treasury note, which is another government-backed insurance. This is not true. Over the course of years, mortgage rates and the 10-year Treasury note will track together on any given day. However, there have been plenty of days that you can look and the mortgage bond of the Treasury notes are different than the Fannie Mae 30-year bond, which is what mortgage interest rates are directly tied to. So if you watch the Fannie Mae 30-year bond, you'll be able to determine what interest rates are doing. So just kind of a wrap up here on mortgage interest rates, because that's my arena and that's where you have some confusion as far as to follow. It just depends. There's a lot of factors there. Normally, when the stock market does well, the bond market does opposite. Mortgage rates tied to the Fannie Mae 30-year bond. That means if the bond's trading at a higher price, it's good for interest rates, they'll go down. If the bond market's trading at a lower price, bad for interest rates, they'll go up. Reason it's opposite of the stock market is because if we have great economic news, where are the investors investing? They're investing in the stock market for a higher return. If we have bad economic news, most investors are going to pull out of the stock market. They're going back into the bond market for the security. Again, good for interest rates. So lots of information that we could talk about on interest rates, but we only have an hour for the show, and I have much better things to talk about, which is our real estate panel. So coming up next in the Money Hour, the show today is all about real estate. We've got experts in studio. Lori Way with Coldwell Banker Bain, Jennifer Nielsen with Real Living Northwest, Jeff Dickinson with Remax on the Lake, Katie Frazier with Trident Realty Group Northwest right here at 1150 AM KKNW after this short break.